Recession headlines are loud, but your money strategy doesn't have to mirror that noise. What if the best time to invest is when people feel uncertain, not when markets are on a hot run? In this video, I'm sharing a practical, repeatable plan you can start today to protect and grow wealth during tough times. Fear is a normal reaction when your balance sheet looks crowded with questions, but action keeps you in control. The goal is to turn fear into a set of concrete steps you can repeat, no matter what the market does. Small, steady progress beats big, reckless moves that vanish in a few months. First, lock down your foundation with an emergency fund you can actually rely on. Think 3 to 6 months of essential living costs, tucked in a high-growth savings account, or a short-term deposit if your country allows it. This isn't money for stocks. It's the cushion that stops fear from turning into panic selling. Next, get honest about debt, especially high-interest credit card debt or loans that carry double-digit rates. If you can, pay down or refinance those debts so the monthly bill becomes predictable rather than painful. Reducing interest payments frees up room for real investing later. Then, dial in the budget so you know where every dollar goes and where it can stay longer. Track your income, pin down essential expenses, and set a cap on discretionary spending that mirrors your current realities. Automate savings and bill payments so the habit sticks even when markets wobble. Set clear financial goals that can guide decisions. A target might be building a steady investment habit, paying off a specific amount of debt, or growing your retirement fund by a certain percentage over the next year. Goals keep you focused when headlines try to pull you off course. Step 1 is to build a cash buffer you can access in days, not weeks. That means keeping your emergency fund in an account you can withdraw from quickly, without penalties, and making sure you know the process if you need it. This is the raincoat you wear before you even consider crossing into the storm of market volatility. Step 2 is cutting costs without apologizing for it. It helps to review subscription services, bank fees, and recurring small expenses, then redirect a portion of those savings into investments. The goal isn't deprivation, it's freeing up capital so you can invest consistently regardless of the market mood. Step 3 is a debt plan that fits the new reality. If high-interest debt remains, prioritize paying it down while preserving enough liquidity to stay calm. If possible, consider refinancing to lower rates or extending terms to reduce monthly pressure. Then reallocate the shaved interest toward investments that compound over time. Step 4 is choosing an investment approach that thrives in uncertainty. The core idea is to combine broad diversification with a bias toward high quality, meaning companies or funds with strong cash flow, healthy balance sheets, and resilient business models. You don't need to chase the hottest trend. You need a plan you can repeat when prices swing. One practical technique is dollar-cost averaging, investing a fixed amount at regular intervals, regardless of price. Automate this through your broker or retirement account so money goes in on payday or each week. Over time, this lowers the impact of volatility and avoids the trap of trying to time the bottom. Another key idea is to prioritize quality and balance inside your portfolio. Favor assets with predictable earnings, competitive advantages, and manageable debt. Mix stocks with broad market funds, bonds, and perhaps a small allocation to real assets so risk is spread, not concentrated in a single bet. During a recession, a modest bond allocation can reduce risk and provide ballast when stocks swing. Look for high-quality government or investment-grade corporate bonds and keep the duration short to protect against rising rates. Bonds aren't exciting, but they can make a big difference to stability and sleep at night. Think about sectors that tend to hold up better in downturns, like healthcare, utilities, and consumer staples. These areas offer defensive cash flow even when other parts of the economy slow. It doesn't mean you ignore growth, just that you balance it with steadier businesses. Consider a cautious exposure to real assets if valuations look reasonable, such as real estate investment trusts or timber and infrastructure funds. Real assets can provide dividends or income when stock prices fluctuate, but they require research, cost awareness, and patience. Don't overcommit. Treat them as a small, purposeful part of a larger plan. Valuation discipline matters more during a recession because prices can swing with sentiment rather than fundamentals. Learn a few valuation guardrails like price to earnings or price to book checks, and compare similar businesses. If a stock or fund looks expensive versus its long-term history or peers, wait rather than chase it just because markets are lower. Create routines that keep you from reacting emotionally. A weekly check-in on spending, a monthly review of contributions, and a quarterly rebalancing can change the game over time. Use this habit to learn from mistakes, not to punish yourself for them. For the next 90 days, run a simple experiment. Automate the maximum affordable monthly investment, cut at least one recurring expense, and track how your net worth moves as prices shift. Document what works and what doesn't, then adjust your plan rather than abandoning it. The goal is momentum you can carry into calmer times. Some mistakes can derail a sensible plan, especially during a recession. Trying to time the market, chasing fancy single-asset bets, or ignoring fees can all erode returns. Remember that diversification and low costs beat bravado and hype, even when others look like they know more. Recession investing isn't about heroic moves, it's about steady habits, clear goals, and disciplined choices that survive volatility. Lock in a small emergency cushion, clean up debt, automate savings, and invest with a plan that prioritizes quality and balance. When you keep showing up, the numbers start to look more like a plan and less like luck. If this felt useful, hit like, subscribe for more practical money talks, and drop a comment with one action you will take this week to start building resilience. Thanks for watching, and I'll see you in the next video.